Due to skyrocketing mortgage rates that have reduced purchasing power and caused a decline in home values, American homeowners are experiencing the abrupt decline in their home equity for the first time in a decade. Real estate analysts point out that the enormous equity loss, which is expected to worsen, is already stifling economic expansion because people have less money to spend on necessities, put aside for the future, or invest to increase their wealth. Recent buyers are uneasy due to the downturn's acceleration because they fear that falling prices will keep them in their expensive mortgages and have distressing consequences like tighter budgets and postponed retirement. In this video, we will talk about the housing crash is here, and it's worse than you might expect. But before that, please like, subscribe, and click the bell button for the latest economic updates. Now let's get started. According to information released in September by mortgage services company Black Knight, equity owned by mortgaged homeowners in the United States has decreased by a total of $1.5 trillion since May. Since that time, the number of mortgages that are underwater, meaning that the borrower owes more than the house is worth, has more than doubled. 450,000 homeowners are currently in default on their mortgages. Overall, since the Federal Reserve started slowing the economy to contain inflation growth, the wealth of American households has vanished, collapsing by more than $6.8 trillion since January. According to data from the Federal Reserve, the combined net worth of U.S. households fell to $143.3 trillion last quarter from $145 trillion the quarter before and $150.1 trillion at the end of last year. Since higher mortgage rates are making homes more unaffordable and raising the average monthly payment by over $1,400, the decline was primarily caused by weaker demand. According to the National Association of Realtors' most recent report for the 10th consecutive month, sales of existing homes, which include single-family homes, townhomes, condominiums, and co-ops, fell to an annual rate of 4.4 million from nearly 6.5 million in January, a decrease of almost 30% from a year earlier, and 6.5% from October. In addition to watching the value of their homes drop like a rock, Americans have also had to take on loads of new debt in order to pay for basic expenses. According to the report, in the third quarter, total household debt increased by 6.3% on an annual basis to $18.8 trillion, with credit card borrowing growing quickly as families became even more cash-strapped. All of these figures indicate that homeowners, especially those who buy their homes this year, are at risk. According to Black Knight data, roughly 10% of American households that bought homes with mortgages in 2022 are already underwater, and at least 40% have less than 10% equity. As home price declines pick up speed in 2023, Black Knight Vice President of Research Andy Walton predicts that more people will go into debt in the near future. A few weeks ago, the Dallas Fed issued a report cautioning that the housing market may experience a 20% decline before returning to its fundamentals. Since prices have increased by 47% since 2020 and wages have actually declined by 3.7%, only a much steeper decline would correct the imbalances that the current economy is currently experiencing. 20 national decrease would look like. As a result, they found that an estimated 7% of homeowners, or 4.5 million, would then be underwater, putting them at an increased risk of foreclosure overall. However, Boston University economist Adam Guerin argues that consumers make less spending decisions when home prices are falling because they have less equity to spend through home equity lines of credit and cash-out refinancing, but also because some homeowners do end up in a worse financial situation as a result of the decline in home values. Even though lower home prices might make it easier for first-time buyers to enter the market, the so-called housing wealth effect's creator, Guerin, warned that larger declines of around 50% could have a devastating effect on the entire economy, forcing consumers to cut spending by roughly $440 billion. However, in some markets, such as Los Angeles and San Francisco, home prices have already fallen 10% from their peaks. If they experience a medical emergency or job loss, current advertisements stress the value of home equity in a society where many people lack sufficient savings and must pay enormous medical expenses. According to Gupta, a study co-author and finance professor at NYU, cancer patients with no equity were more likely to reject treatment than those with positive equity, who tend to withdraw money from their homes and are more likely to accept treatment. If you have the asset buffer of a house, it's something you can use to deal with unanticipated events. Up to this point, the higher rates and the lower prices haven't produced any of the benefits. First-time buyers are having a really difficult time because of the high costs, high entry barriers, and high mortgage rates. According to sales in November were actually at their lowest level since May 2020, when the housing market was at a standstill after lockdown started. In addition, sales last month were the lowest since December 2011, which means that more prospective home buyers were prevented from qualifying for a mortgage in November as mortgage rates rose. Yun added that the effects are more pronounced in expensive regions of the nation, and in markets where home prices have increased significantly in recent years. The effects are currently having an effect on sellers as well. They are either removing their properties from the market altogether or lowering their asking prices more quickly than they have in recent years. Fair-driven is the housing market index, a closely watched industry metric that assesses the outlook for home sales, declined to 33 on a 100-point scale in November, its lowest level in a decade. Typically, anything under 50 indicates that the market is sluggish. A bubble burst is making conditions worse for everyone, including owners, buyers, sellers, and even real estate agents. At this point, we're already in a housing recession, but the central bank seems to be threatening to turn it into as owners close deals on homes that were put under contract at the end of this year. The price declines will start during the first quarter, according to Deputy Chief Economist Taylor Moth, who also noted that home prices have already started to decline on a month-over-month basis in many markets. The most concerning aspect of everything is that if the housing market declines, the entire economy will follow and everything will start to fall apart. Recently, the effects have also been felt by sellers, who are currently either lowering their asking prices faster than they have in recent years or pulling their properties off the market, which together creates a fair-driven market. Conditions are getting worse for all owners and buyers due to the bubble burst. The Housing Market Index, a closely watched industry metric that assesses the outlook for home sales, declined to 33 on a 100-point scale in November, its lowest level in a decade. Typically, anything under 50 indicates that the market is slumping, according to Redfin. A deep freeze in home sales is likely to result from the central bank's threat to turn the housing recession into a housing depression. Prices will start to drop during the first quarter as owners close deals on homes that were put under contract at the end of this year, marking the steepest decline since the previous bubble burst. So, what's your takeaway from this video? Let us know in the comments section below. If you found this video thrilling, make sure to hit the like button. Also, subscribe to the channel and press the bell icon to never miss an update from us. Thank you for watching. We'll see you at the next one. Until then, peace.